Hi guys, and welcome back to the channel. One of the simplest and widely used approach to value a company is the relative valuation or multiple technique. If you have ever read an analyst report, chances are quite high that they were applying a multiple technique to value a business. Most of the people feel quite comfortable in computing the price earning or price to book value multiple. But are they really computing the right multiple? Are they really able to interpret the result and take an informed decision based on that outcome? In this video, we are going to address these points and teach you how to use the multiple and how to perform a thorough analysis based on that. So fasten your seatbelt because we are about to start. In the relative valuation approach, you are valuing an asset in relative terms by looking at the price of comparable asset. By using this approach, you are not valuing the company based on its fundamental, but rather define how much it is worth in relation to its peers, because you think that the market is correctly valuing the sector, but not the single company. A multiple is computed by taking the ratio between the amount paid for the asset and the benefit that the investor obtains. At the numerator, we have the price per share, the market value, or the enterprise value, whereas at the denominator, we have the benefit obtained in terms of earnings, revenue, book value, cash flows. There are three fundamental steps you need to master in order to apply the relative valuation or multiple technique. The first one is to identify a peer group of the company you want to assess. This is usually done by looking at the sector or industry. However, given that absolute prices cannot be compared, we need to standardize by some relevant metrics. We need to identify a relevant metric by which we need to standardize the price and therefore compute our multiple. As a third step, we need to define some relevant statistics that will allow us to apply the final multiple to our company and therefore derive its price. Easy, right? Not really. There are other things which are ignored by most of the people, but which are paramount in order to define the right price of the company. How many companies are out there with the same business model, the same business line, geographical location, and balance sheet feature? Probably none, right? But you should be aware of those differences and control for them when defining your peer. Also, once you have defined the multiple and the price of the company you want to assess, this is not the end of the story. If you don't want to make a very bad investment decision, you need to start from that outcome and investigate the main drivers. In other words, you need to identify whether the market is mispricing the company or if there are good reasons for that company for being over or undervalued. Finally, if you want to venture outside the most commonly used multiple and define new ones, then you should be consistent in defining the new multiples, which means that both the numerator and the denominator should be expressed, for instance, as equity value or enterprise value. If we look at the distribution of the PE of listed European companies in 2022, we can easily understand how likely it is that extreme PE values are going to inflate the average of the sample and therefore the outcome of the entire analysis. This is because none of the multiples present a symmetric distribution. They cannot have values below zero, but they can have extremely high value, which in the end deliver an asymmetric distribution. From the table you can see how the average was affected by those extreme values, but also the high standard deviation of the distribution. This is why it is important to look at the median instead of the average when performing a relative valuation. I will now go through some examples touching upon the main multiples and steps you might want to follow in order to perform a relative valuation. Price-earning ratio, or PE, which is probably the most known and widely used financial ratio in the world. It is defined as the market price divided by earning per share, EPS, which are computed by taking the bottom line of the income statement, the net income, and dividing it by the total share outstanding. This gives you the net income per common share. There are many variants of the PE. especially in the denominator. That is where the magic is taking place. When using the most recent financial year data, it is called actual or current EPS. When using the most recent 4-quarter, it is called the trailing EPS. When using the forecasted earning, it is called the forward EPS. But you can also consider earning diluted or basic, with or without extraordinary items. In terms of meaning, the investor is basically paying the PE multiple for every dollar of earning, or alternatively, at the current level of earning, it will take the company PE years to pay back the share price. So the lower the PE of the company, the less the investor is paying for the earning. Another way to look at the PE is to reverse the ratio, to obtain the so-called earning yield. This measure is telling you for every dollar invested in the company, the percentage of profit you should expect to make out of it. This is very convenient because it allows you to compare not only different companies but also different asset classes. By looking at the main driver that determine the PE, we surely have the amount of profit the company is paying out as dividend, the payout ratio, which is positively correlated with the PE because the more dividends a company is paying, the more expensive that company has to be. Then we have the cost of equity, which is negatively correlated with the PE because the riskier the company, the lower the price the investor should pay. And finally, the expected growth rate, because the faster a company is expected to grow, especially with respect to the peer, the more the investor has to pay for that company. Let's now move to an example to better understand how to use the PE ratio to value a company and how to better analyze the outcome. In this example, we are going to perform a relative valuation in order to determine the value of Ralph Lauren stock by using some past data. As a first step, we are going to identify the peer group, which in this case belongs to the apparel sector, and download some basic past market data like the market cap, the share outstanding, the price, and the net income of the most recent financial year. The ratio between the net income and share outstanding give us the EPS, which we can then use to compute the PE as the ratio between the price and the EPS. At this point, the median of the PE of the peers equals 16, which is the estimate for Ralph Lauren PE, which leads to a price of 129. We can now compare our estimate with the actual PE and price of the company and realize that there was a mismatch, as the company appeared to be undervalued with respect to the sector. So let's now analyze the main driver to understand if the market was right about this mismatch. Let's start from the payout ratio, where we do see that Ralph Lauren was actually not among the top dividend payers, but slightly below the average. The cost of equity, which I would recommend to read in conjunction with the return on equity, highlights a company that was slightly less risky than its peer, but that was also the one, together with Hugo Boss, to generate the lower return. The cost of equity is a controversial topic, which should be subject to a case-by-case assessment. In case you want us to delve into the cost of equity topic with a dedicated video, write equity in the comments below. If we reach 100, the video will be on its way. And now, back to the show. Finally, and probably the most relevant driver in this example, the expected growth rate, which is highlighting Ralph Lauren as a clear outlier with respect to the sample. So in the end, we can say that from a PE perspective, Ralph Lauren appear undervalued, but the company was clearly expected to grow less compared to its peer, which is probably the reason why the market was pricing this mismatch.
They happen to be of companies that grow in earnings fast. These people pay very little attention what earnings, actually a lot of times they pay no attention what the company even does, but they pay no attention how much they're paying for these earnings, etc. So one of our largest positions is Uber. And by the way, I'm a value investor. Yeah. And Uber is a company that probably lost more money of existence than communism combined. And I still own the stock because in our analysis, we came to the conclusion that as Uber's revenues grows, keeps growing, it's going to become incredibly profitable. So I was willing to pay infinite price to earnings. If you look at the earnings when I was buying the stock, because it was not making any money, and I would argue I got a bargain because I was paying a very low price on price to future earnings. Mm-hmm.
The price-sales ratio, OPS, is defined as the market price divided by sales per share of the company. The investor is paying a PS multiple for every dollar of annual sales, or alternatively, at the current level of sales, it will take the company PS years to pay back the share price. So the lower the multiple of the company, the less the investor is paid for total sales. In terms of main driver that determine the multiple, we do have the payout ratio, which is positively correlated with the multiple because the more dividends a company is paying, the more expensive the company has to be. The cost of equity, which is negatively correlated with the PS because the riskier the company, the lower the price the investor should expect to pay. The expected growth rate, because the faster a company is expected to grow, the more the investor has to pay for that specific company. And finally, the net profit margin, which is, in my point of view, the most important one, as the higher the margin the company is able to generate, the more the investor has to pay for that company compared to the peers. So now let's move to an example to better understand how to use this multiple to value a company and how to analyze it. In this example, we are going to perform a relative valuation in order to determine the value of Albertson stock by using some past data. As a first step, we are going to identify the peer group, which in this case belongs to the food retail sector, and allowed some basic past data like market cap, share outstanding, price and sales. The ratio between the price and sales per share give us our multiple. At this point, the median of the PS of the peers equal 0.70, which is our estimate for Albertson, which leads to a price of 93, which appear to be considerably higher compared to the price at that time of the company, 22. So let's analyze the main driver to understand if the market was right about the mismatch or if there was a bargain. Let's start from the payout ratio, where we do see that Albertson is paying out only 17% of its profit, one of the lowest percentage, but there was also Dollar Tree that was not paying dividends at all. The cost of equity points to a company with one of the lowest cost of equity. However, the expected growth rate is highlighting how Albertson was barely growing at that time and its profit margin was among the lowest in the ranking. So probably at that time, the low price sale multiple of Albertson was reflecting precisely these two aspects: lack of growth on one side and a very low profit margin on the other side. The price to book value ratio is defined as the market price divided by the book value per share of the company. The investor is paying the price to book value for every dollar of book value per share, or at the current level of book value per share, it will take the company price to book value year to pay back the share price. So the lower the multiple of the company, the less the investor is paying for the book value. In terms of main driver, we do have the return on equity, the most important ones, which is positively correlated with the ratio because the more return the company is generating, the more expensive the company has to be. Then we have the cost of equity, which is negatively correlated with the multiple because the riskier the company, the lower the price the investor should expect to pay. And finally, the expected growth rate, because the faster a company is expected to grow, the more the investor has to pay for that company. Let's now move to an example to better understand how to use this multiple to value a company and how to better analyze the outcome. In this example, we are going to perform a relative valuation and we are going to target Citigroup. As a first step, we are going to identify the peer group, which in this case belongs to the banking sector, and download some basic past market data like the market cap, the share outstanding, the price, and the book value per share. The ratio between the price and the book value per share give us the price to book value. So at this point, the median of the price to book value of the peers leads to a price of 92 versus a price at that time equal to 39, so clearly undervalued. So let's analyze the main driver to understand if the market was right about this mismatch. And let's start with the expected growth rate, which is already showing how Citi was among those banks with the slower pace of growth. Turning to the cost of equity, Citi was in line with the other banks, but clearly the same cannot be said for the return on equity, the ROE, where the Citi appears to generate one of the lowest return, 6.7%. So in the end, to wrap up, the market was probably penalizing Citi from a price to book value perspective because of the gap in terms of ROE compared to its peers. The EV to EBITDA multiple is defined as the enterprise value divided by the earning before interest, taxes, depreciation and amortization of the company, where the EV is computed as the market cap plus total debt less cash. The investor is paying this multiple for every dollar of EBITDA produced by the company, or alternatively, at the current level of EBITDA, it will take the company the multiple year to pay back the share price. In terms of main driver, we do have the return on capital, which is positively correlated with the multiple, because the more return the company is able to generate, the more expensive that company has to be. Then we have the cost of capital, which is negatively affecting the multiple, because the riskier the company, the lower the price the investor should pay. Then we have the expected growth rate, because the faster a company is expected to grow, the more the investor has to pay for that specific company. Then we have the tax rate, because the higher the tax is, the less income remains available to shareholder, and therefore the cheaper that company has to be. And in the end, we have the reinvestment costs needed to maintain the company operation, which are of course negatively affecting our multiple. Let's now move to an example to better understand how to use this multiple to value a company and how to better analyze its outcome. In this example, we are going to perform a relative valuation and we are going to target any. As a first step, we are going to identify a peer group, which in this case belongs to the oil and gas sector, and download some basic past data like EV, total debt, cash and equivalents, share outstanding, price and EBITDA. The ratio between the enterprise value and the EBITDA give us our multiple. So at this point, the median of the multiple of the peers equals 4, which leads to a price of 23, compared to a multiple and a price for any at that specific point in time, which were respectively equal to 2.7 and 16. So clearly we do have a mismatch here that we can analyze by looking at the main driver. By looking at the reinvestment cost computed as capex and depreciation cost divided by EBITDA, we see that Eni was indeed the company with the highest cost required to sustain its business. Moreover, Eni, despite having one of the highest cost of capital computed with the weighted average cost of capital, was the one generating the lowest return, only 6.5%. So the discount at which Eni was trading at the time was precisely reflecting the fact that the business was requiring higher annual cost compared to its peer in order to maintain the same level of operation, and that the company was not able to generate a return on its capital above the cost. With this example, I hope I was able to prove you that most of the time there are good reasons for a company to look cheaper compared to its peers from a relative valuation approach, and that you should not blindly take the outcome of your assessment and jump to a conclusion. So here it is my opinion on the relative valuation approach. I think it's a quite simple and straightforward way to assess a company, and it can be quite useful to compare across peers, providing that you go beyond the pure outcome and try to understand the main drivers. However, I think it suffers from two main problems. The first one is that you can always find over or undervalued company regardless of the fact that the sector itself can be over or undervalued compared to the market. In other words, if you pick a sector, I can tell you in few minutes a company that is undervalued according to whatever multiple. The second problem is by far the mostly used approach from market analysts, because it is much easier to sell something and to build a story out of that with a relative valuation compared to the intrinsic valuation approach. I always prefer to look at the fundamentals of a company and try to guesstimate how much it can be worth in the future by using the intrinsic valuation approach. I also do use the relative valuation to complement the outcome of my assessment at the very end of the process and to understand if there were some blind spots that I might have missed. Also, I can use the relative valuation to screen for possible companies that I might then study with the intrinsic valuation approach. If you reach this point in the video, it means that you are now able to understand and correctly apply the relative valuation approach. In next video we are going to explain the intrinsic valuation approach and shed some light into its nuances. If you really like this video, please do not forget to give a thumbs up, subscribe to the channel and pin the notification bell. Cheers and see you next time.